Wall Street owns more of your life than you think. While you debated mortgage rates, Wall Street bought America $800 billion worth. What is that? They bought warehouses. They bought data centers. They even bought the land under your grocery store. You don't own the economy anymore. You rent it. But here's what they don't want you to know. That's interesting, though. It's an interesting concept, right? Everybody wasn't paying attention, and the institutional buyers are coming in and buying everything. All the dirt under all these businesses, all these warehouses, Amazon.
I kind of believe this. I kind of don't, though. I don't. I
Fuck
mean,
yeah, they were. Fuck yeah, they were. You two were arguing about mortgage rates again, like 2024 rates. And here we go. It's buying $800 billion, not on houses, warehouses, data center, and the land under retail stores, or as Travis say, retail shores. They bought the entire structure of the economy. All the American.
okay, it's true, but 800 billion is 800 billion is nothing, though. So if we're going to use that number, that's nothing. There's trillions of dollars in real estate. Here's what I hate about this intro. Okay, but I don't like this intro because I don't want to give people the license to be like, well, private equity owns it all. You got to realize there's a lot of things and the high value that is still owned by individuals. MAPAs, like it's not just all private equity. Yes, this happened. It's happening. It's called consolidation, right? They buy it, they roll it up into a REIT, and they go public with it. But like there's still the nice thing about real estate is still extremely fragmented. It's not there's a ton more consolidation to happen over time.
There's a thesis there. Like mobile home parks are a great example. Institutional players are coming in and buying up 100 space plus parks, bigger parks, right? Maybe more institutional grade parks. And that's great but that low hanging fruit's running out, at least in the mobile home park space. So there's something to be said for buying that sort of like maybe $1 to $5 million mobile home park and then improving it. And then you're going to have REITs that run out of big stuff to buy, and they're going to come down and start buying the smaller stuff, especially if you've improved it, you've stabilized it, and they could be paying premium prices, low cap rates. And we're seeing that. And I think that's kind of what this intro is saying is like, institutional money is coming in and buying a lot of shit, not just warehouses, not just the land under your grocery store. They're buying mobile home parks. They're buying, I think apartment buildings, self-storage, a lot of that stuff's been consolidated a lot. But there's certain asset classes out there that you can actually do really well while you own it, pay debt down, force appreciate it, create cash flow, and then just sort of consolidate, maybe build a small portfolio and exit to a REIT later. And they're going to pay a premium. They're going to pay you more than, let's say, another mom and pop or maybe a slightly larger buyer would pay because they're getting economies of scale. So there's a play there for sure.
Well, but also it's interesting because we had Frank Rolfe on here a couple episodes ago. He's like one of the largest, MHP buyers in the country. And he was talking about like the cycle of consolidation. He's like, yeah, but this stuff just goes all back to MAPAs again anyway. In other words, it's a bunch of MAPAs, and then there's smaller consolidators, then there's bigger consolidators, then they move up to private equity, and then they move up to a REIT or an IPO of some kind, and then the IPO, the new company, usually screws it off, and they end up going private again and selling it off, and they sell it off in pieces to MAPAs. We start the whole thing over again. So I think it's the same in most industries where yes, it moves up the value chain, but the fact that the value chain exists is really important because it gives us an opportunity to create value and consolidate on the way up. I don't think it's like once it's all bought and there's nothing left ever. I do
So
think there's a cycle to this.
Are you saying he's wrong? Like, is private equity not buying these up, or it's just not in the where mom and pops are going to?
We're in the cycle for it. Yeah.
I think he's right, but I think we're in the cycle for it. And I don't think that it's like you take it from the, you buy it from the MAPAs and it's in private equity forever. I think that there's multiple truths. Yes, private equity is buying and consolidating. Yes, also we have multiple millions of opportunities still in the hands of MAPAs. And also, once those properties are consolidated, they'll go through that cycle, and sooner or later they'll end up back in the private industry. So like, I don't want this conversation to sound like, oh, there's not any opportunities. Even in properties over 5 million, I think there's still opportunities, and I think there always will be.
There's always opportunities, but let's take some scenarios. Like, I'm curious to your thoughts on that. Okay, you take the Amazon warehouse near your house, right? Let's say it's institutionally owned. The data center powering your apps or powering AI. Maybe it's bought by a fund or another institutional strip mall. Same thing, right? They're owned by these large, private equity institution, these funds, these groups. They go through that life cycle, and then what? Like, where's the opportunity for, say, the average investor? We're not talking small under $5 million properties. We're talking big tens of $1 million, worth of real estate that these institutions own. At what point do they sell off? Do they liquidate? And how are these, Main Street investors, buyers financing these properties? And where is there an opportunity to actually make money, build wealth when private equity starts eliminating their portfolio?
If you like what you're hearing on this podcast and want to come and hang out with us, as well as other members who are scaling in cash flow real estate, you've got to check out our Elite Mastermind. Inside, we've got investors who own hundreds of millions of dollars in real estate and are doing amazing things. We'd love for you to come join us. Click the link below.
Well, I mean, I think that any institutional player, whether it's a private equity fund or even if it goes to a REIT and goes public, I mean, Mitch mentioned earlier, he said screw it off. I'm not quite sure what that means. Maybe we'll take that offline. But they screw it up, Mitch, is maybe what you meant to say. They screw it up. You said that, actually, and we can go back and listen to the tape. Anyway, regardless, these institutions need a capital event, which is usually a sale, because they need to provide a return back to their investors, right? It's not like I sold my company to private equity. They took it, that we did more consolidation. They sold it to another private equity. It's actually, I've heard it's maybe selling again to private equity. It works up the value chain, but eventually every 5 years they have to exit these properties to get that cash event to then return capital to their investors, provide a significant return in the form of like an internal rate of return. So, I mean, that might be where it's at, or they might just screw it up.
I was actually asking because it was a leading question that I was going to answer myself.
Okay. Sorry.
I think I'm just kidding. I think it ties back to what we talked about in a past episode. We talked about seller leasebacks. So I actually think that there might be an opportunity where private equity, right, or the owner of these properties, they want to create a liquidity situation. So they've owned the property for a while. They're operating out of the property for a while, or they have tenants operating out of the property for a while. And now they want to take the equity in that building and go redeploy that into other businesses or in other real estate. That's where I think there could be an opportunity as the cycle comes full circle, right? That these properties that institutions are buying will do some sort of seller leaseback, or there's an opportunity for another buyer to come in, take control of this property, lease it to whoever's currently operating in that business, while private equity goes and redeploys that capital into another business or more real estate.
Or they recapitalize, they get a cash event, and then they are able to provide some return back to their investors, which is kind of the point I was making. But yeah, I mean, you can provide capital back to investors by a full out sale, or just sell the building, hold the business, et cetera. So yeah, I mean, I think...
I also think it's true that certain properties can get locked up for multiple years inside this sort of value chain. You look at some of these larger mobile home park buyers, they own a couple hundred or a couple thousand, parks. They don't want to sell because what are they doing? They're consolidating. Someday they'll sell, but they're not going to sell to you as an individual investor. They're going to sell to a private equity company. So those specific properties could be locked up inside that value chain for multiple years. It could be 20, 30-year cycle or whatever that is. So that's true, but it's not all mobile home parks or industrial buildings or retail, whatever your asset class is that's locked up in that. The real estate, there's millions and millions of properties throughout the country. So even though they've consolidated whatever the number is, 800 billion, or it's probably more than that, there's trillions and trillions of dollars of real estate, and there's multiple millions of situations out there. So you just got to figure out who owns the property, make contact and understand that and get the story. And then you can go from there to see if there's opportunity.
Yeah, I think you have a great point, Mitch, too. It's like we can talk about hundreds of billions of dollars, and we can talk about private equity or these big institutions buying up commercial properties, residential properties. It doesn't matter. The reality is, like, it's still these individual owners own a lot of the real estate and a lot of the wealth in our country. I know we did a past episode. Mitch, I don't think you were on. Travis and I did an episode, talking about this on the single family side.
It was a great episode. So
yeah,
good.
I knew that was coming. Yeah.
Travis said it was the best episode. I mean, it was all right. It was all right. But I think it's something like when I looked into the data, it was like 0.6% of, I believe it was single family homes, 0.6% of single family homes is owned by private equity, BlackRock, one of these big groups. And I'd be curious to see the numbers on the commercial side too, because you to your point, hundreds of billions of dollars, but that's still a drop in the bucket to how much real estate is out there. I'm always amazed at when I see these Starbucks, 7-Eleven, a lot of these big commercial, operators that don't actually own their real estate. It's still owned by local investors or a small group of investors, not these large institutions. So I do think from a mindset standpoint, I really don't want our listeners to think like, oh, it's too late. Oh, I can't get in, because it can feel that way. But I don't think that's ever actually like, there's always an opportunity.
Here's just a quick search. It says while over 90% of total commercial real estate is privately owned, over 90% is what this says. Direct
But is that
ownership.
private equity though? Because that can be categorized as privately owned, not publicly traded.
No, this is privately owned. Direct ownership specifically by private equity firms vary by sector with notable growing presence in multifamily. Blah, blah, blah. Private equity firms own at least 10% of all U.S. apartments. So they own 10% of apartments.
Well, so think about that. Like, I think if I'm a private equity, if I'm a BlackRock and I'm looking at my holdings, I'm going to make a lot more money and return a lot capital a lot faster and create a much higher return on investment by buying businesses. Because with businesses, you actually get a lot more scale and consolidation, right? If I go buy a bunch of businesses, I have, a regional manager, I have a CEO. I mean, I can use systems across the board and then take out cost, drive up my EBITDA where I get a much higher multiple. And I can create a lot more wealth, a hell of a lot faster buying businesses. So that makes sense where maybe sub 10% of their holdings would be real estate. But I do, I mean, if you take anything away from this episode, I think there is a lot of merit in buying real estate in an asset class that's sort of pre-consolidation or just starting consolidation, right? And that's what we were talking about in a previous episode, whereas maybe apartments, self-storage, and other types of asset classes, there's been a lot more consolidation, whereas like over 70% of mobile home parks, for example, are still owned by private owners. But we know private equity is getting a lot more interested in the asset class. So just buying those assets, holding them, private equity is going to come into a market, they're going to jack rents up. And it sucks for the tenants, but they jack rents up and they drive values up, which then brings your values up and brings your rents up. So, and then you exit to them and you sell them at a premium price. So there's strategy there.